Good morning. I'm Jonathan Camarda, Chief Investment Officer of Camarda Wealth Advisors. Quick intro for those that don't know me. I am a chartered financial analyst, chartered alternative investment analyst, and a chartered market technician. Won't bore you with some of the other credentials that I have. Getting right to what's going on. Obviously, it's been a volatile start to 2022, as Jeff has intimated in his videos over the last several months. So to kind of give you a high level view of what we've been seeing, as we have gone from what the Fed has termed as a transitory inflationary situation to something that looks like it may be a little bit more here to stay. So what that means generally is, again, is that cost of goods are going up. And I don't need to tell you folks out there at the grocery store, Best Buy, even homeowners insurance, that everything that you're paying for, the price is going up. What this means from an investment standpoint is that the script has flipped. Fixed income, which has enjoyed a 40-year bull run, is coming to a halt, and certainly did last year as bonds were actually down last year. So what that means, again, for clients that generally were under the advice of 60-40 strategies with fixed income offsetting the value at risk, as we call it in Wonkland, of equities, stone has been removed. So we have to be a lot more diligent in exactly how we're managing our money. So case in point, sectors that have changed since the rebound of the COVID demise, technologies and consumer discretionaries, those generally don't do well when rates rise. So you may ask yourself why. And the reason being is based upon what, again, we call in quant land, the dividend discount cash flow models. When rates go up in the denominator, prices go down. Probably deeper than you wanted to get there. Companies like cyclicals, energies, commodities tend to do well. And that's why you saw we had energy last year and it continues to excel, not only based upon the business cycle that we're in, but of course, with the global geopolitical macro risks that we're looking at, although we might have a glimmer of hope this morning as I record Monday, February 14th, 2022, but no promises, obviously, from this host. As we get through some of the data, last week's really stoking those flames was a CPI number of 7.5%. And you may see not only Jeremy Powell, as I like to call him, Jerry Powell, Jerome Powell come out, but also Bullard from St. Louis, who's usually a hawk, came out as well and continues to stoke more of the inflationary situation being more sinister as you hear less of that key adjective of transitory. In fact, you don't hear it anymore except in the rearview mirror. What this means is that we have to be eternally diligent, pardon me. So you might see in your strategies changes being made as we start to look at the ever-changing landscape. Again, even conservative clients, we've had to look at alternative assets to reduce what they call correlation or stuff all moving in the same direction, certainly with your equity component. As we move through, the economy has actually started to improve. Earnings has actually been attractive this season, and COVID is certainly starting to, again, fold into the backdrop with Omicron at least, although, again, don't quote me on that. That has been overruled by this inflationary fear that is out there. As again, 5 to 7 hikes have been projected for this year. Now, some analysts think that 7 has already been baked into the cake for the market where we currently are. And if that's the case, we could perhaps see some green shoots as we move through mid-year. However, again, too soon and too little data to suggest that's accurate. So therefore, we have to, again, be continuously vigilant. So again, we will continuously make changes as we look at different asset classes and sectors that, again, do better in this environment. As I already mentioned, industrial, cyclicals, energies, less on the technologies and the discretionaries. And again, the day-to-day, remember, volatility, as you all know, and I'll finish with this, since COVID, has increased not only through the pandemic or the inflation fears, but remember, it's the algorithms, the computer traders, the Python and C+ traders out there for large hedge funds and the institutions that have changed the game forever. Okay, you don't see anyone on the floor, at least not making a difference, of the New York Stock Exchange. And because of the computer and the data that we now have in our more powerful machines, the flip side of that is on the downside, you see more vicious turns. So we definitely appreciate your time, your trust, and your patience as we roll up our sleeves and continually work for you. If you have any questions, certainly reach out to your private wealth advisor, your personal wealth advisor, and certainly myself, Jeff, and Kimberly on the investment committee are always available as well. Godspeed, stay warm, and stay frosty. Talk to you soon.